Alright, everyone is talking about electric vehicles, renewable energy, and the chips powering them. But here's the question for investors. What's happening behind the scenes? Silicon carbide is the material powering the next generation chips. It's growing fast, but it's also very tricky. So investors ask, is this the place to put the money? Today we'll break down the silicon carbide market. We'll talk about the opportunities, the risks, and the outlook for the next 2 to 3 years. Why investors care? Silicon carbide sits at the core of EV efficiency, renewable energy, and power electronics. EVs, inverters, solar energy, charging station all need silicon carbide. But here's the catch. The market is volatile. Some major players are restructuring. Stock prices are down sharply. China is ramping up production aggressively. Demanding is growing, yes, but financial and operational risk are all real. This is not just about a technology story. It's about who has the balance sheet, who can survive, and who can capitalize on the next growth wave. Let's talk about the historical context: US, China, and Europe. Let's rewind a few years and talk about some numbers. In 2019, Wolfspeed, also formerly known as Cree, commanded around 60% of the global silicon carbide wafer market. By 2023, that share has dropped around 30%. Meanwhile, China's share rose to around 39 to 45% by 2021. Europe's share in 2021 was approximately 20%, with projection indicating growth to almost 50% by 2033. Unlike China, Europe focuses on quality and long-term strategic partnership. The global picture shows a shift. US dominance has declined, China is growing fast, and Europe is building a strategic strength. Let's move on to market dynamics, 6-inch to 8-inch transition. So the next big change in silicon carbide manufacturing is the move from 6-inch to 8-inch wafers. Why does it matter? Economics, scale, margin. But the real driver is the application. EVs, for instance. That's the real story. Each EV needs roughly 2 to 4 silicon carbide wafers for its power electronics. As EV sales soar worldwide, we need more wafers, more chips, and more production capacity. An 8-inch wafer has 2.25 times area of an 6-inch wafer. More chips per wafer, better cost efficiency. Unit cost can drop about 35%, while yield can increase from 80 to 90%. Yes, Infineon, Bosch, and other big players influence the trend, but ultimately it is driven by the demand. More EVs, more wafers, more production. Let's talk about China. Expansion, consolidation, and quality focus. China has tens of silicon carbide companies, some huge, some tiny, and a few years ago, building a fab became increasingly regulated. Today, more than 50% of smaller Chinese silicon carbide companies may collapse. Consolidation is serious. The survivors, thousands of PVT furnaces, higher volume, and better quality. And recently at the Semi-E exhibition in Shenzhen, we noticed something very significant. Many silicon carbide companies have smaller booths than before. Some used to showcase heavily are now quieter. Why? Because many of these companies are pivoting to survive. Some companies used to only produce N-type wafers are now also stepping into making semi-insulating wafers, while others are also demonstrating 12-inch wafer capabilities even though it's not commercially available yet. These are potentially an indication of either desperate to survive, adapting to attract new investors, or stay relevant. China is shifting from flooding the market with volume to staying focused on quality. New application and future potential, including AI data centers. Silicon carbide isn't just about EVs. Companies are exploring 12-inch wafers for high-volume AR/VR applications, semi-insulating wafers for advanced RF devices, waveguides for photonics applications, early experience with silicon carbide in AI accelerators and high-performance computing. Here is where data centers come in. AI workloads require high efficiency and low power loss, especially at scale. Major tech players are building massive data centers, investing billions in generative AI infrastructure. Silicon carbide can help reduce power losses, manage heat better, and improve efficiency. But how significant is this market compared to EVs? Well, truthfully, it's smaller, at least for now, but it's strategically important. For investors, this may signal potential upside. As AI grows, demands for silicon carbide may rise in unexpected ways, combined with other emerging applications, and the market has room for selective innovation and new revenue streams. Question to think about: which application will scale first? Will 12-inch wafers become mainstream? How will semi-insulating wafers impact the ecosystem? Could AI data centers become a surprisingly large driver and demand in the next 5 years? Demand forecast and observations. So 8-inch wafer market could reach several billions for the next 5 to 10 years. Automotive, renewable energy, and power devices are driving the growth. The risk: oversupply, price compression, and consolidation shakeups. So the opportunities: survivors with strong tech, strategic partnership, and capital could see a major upside. Even in turbulent times, some investors are still evaluating market entry. They have missed the initial gold rush, but now see the opportunity in the downturn. Could this be the right moment to enter, or the right player to scale? These are the questions worth pondering. Silicon carbide is tough, it's complex, it's evolving, but in every challenge lies an opportunity. For those who pay attention, who adapt, and who think strategically, the next few years could be transformative. Innovation, patience, and insight will separate the winners from the rest. Time, courage, and vision are the real advantage. Silicon carbide is here to stay, and I believe there is an opportunity at this moment and also in the future.